why is it that you think there is a new structural regime for benchmark rates that's going to make it a lot more difficult to get them lower over the next 10, 20 years?
So it's a great question, Lisa. So let's cast our minds back briefly to the early 2000s, to Ben Bernanke, and to the famous savings glut hypothesis. So back then, the Fed was hiking, but long-term Treasury rates weren't going up. And Bernanke said, it's because there's a glut of global saving, all of this money coming from China and Saudi into the US Treasury market. And that means even as the Fed hikes, long-term rates are staying low. So the big thesis, which Bloomberg Economics, my co-authors, Jamie Rush, Stephanie Flanders, and me set out in this new book, The Price of Money, is that situation has reversed. And we're no longer in a world with a savings glut. We're in a world with a savings shortage. And that means it doesn't matter who President Trump appoints as the next Fed chair. He can appoint Kevin Hassett. He can appoint Kevin Warsh. He can train an AI model to make the same decisions as Arthur Burns, the notorious Fed chair who cut rates for Nixon back in the 1970s. And he can get a short-term policy rate, but that savings shortage is going to mean that long-term rates, the 10-year Treasury yield, stays high. We think 4.5% for the 10-year Treasury is the new normal.
Yes, something also the administration would not welcome, because also I see you say it might actually trend above that figure. What does this look like in terms of a transition for 4.5% a 10-year yield being the new normal?
So it's a great question, Anne-Marie. So this book's about the natural rate of interest. It's a bit of a wonky concept. It fires the imagination of PhDs and the folks in the Fed, can leave others cold, but it's actually pretty important, right? If you're the US Treasury, well, 10 years ago, you were borrowing at the 10-year horizon with a 2.5% rate. That was very sustainable. Now you're borrowing at a 4.5% rate. Well, that puts us into a world where the US is going to be spending more on interest than it does on defense. If you're in the equity market or the real estate market, if you put money to work in stocks and real estate in the US, pretty much any time over the last 4 decades, you've made a lot of money. And an important reason for that has been that interest rates have been low. Well, if we're right, we're now moving into a world where interest rates are going to be structurally higher. And that means the pressure on stocks, the pressure on property isn't going to be for prices to rise. It's going to be for prices to plateau or maybe even fall.